Assalamu alaikum friends, welcome to lecture 3 of SBR. We are going to start with the first standard, and the standard that I'm going to cover will be in the chronological order. That means I'll be going to start with IAS 1, then IAS 2. So likewise I'll be starting with IAS and then I'll be going to IFRS. So starting with IAS 1 is the presentation of the financial statements. We don't have any question on this, but basically the standard is learned so that you know how to present your financial statements, like your income statement, balance sheet, what needs to come first, what needs to come in the bottom, what needs to come in the middle. So in this lecture we are going to focus on what are the components of the financial statements, what are the elements that makes up the financial statements. Most of this you will be knowing it from your financial reporting. This is just a revision. Then we are going to go through the general features of financial statements. Disclosure. Criticisms of the use of other comprehensive income. So these are the four main areas that we are going to cover. Starting with the components of financial statements. Financial statements are made up of statement of financial position, that is your balance sheet, your income statement, that is your statement of profit and loss, and other comprehensive income. Okay, this one either it can be presented as one single statement where both you have profit and loss and other comprehensive income, or you can present it as two separate statements, one for statement of profit and loss, the other one for statement of other comprehensive income. Then we have statement of changes in equity, statement of cash flow, accounting policy notes, and other explanatory notes. The area that we are going to cover here are mostly statement of financial position and statement of profit and loss and other comprehensive income, the first two, and partly statement of changes in equity, just the format. So starting with statement of financial position, and yes, any reports or statements that are not in this list are outside the scope of IAS 1. That means we do not have any format for them. You can make it in any way. Example, your environmental report or any financial review, they are outside the scope of IAS 1. Okay, so starting with the statement of financial position. In the statement of financial position, there are two things. One is your assets and one is your liabilities. Assets can be presented as current or non-current. Okay, first let us understand what are the characteristics of current. Okay, current asset means it is something that is realized or consumed during the normal trading cycle, or it is held for trading. It needs to be held for trading. You need to be able to sell it in the short term within 12 months, or you are realizing it within 12 months of the reporting date. Anything that you are holding for 12 months, you are going to sell it in 12 months. Within 12 months is current asset. Examples, your debtors, your stocks, they are current assets. Anything which is held more than 12 months, which is not held for trading, which is not consumed during normal trading cycle, are your non-current assets, like your fixtures, plant and machinery, land and buildings. Now we are moving on to liabilities. Liabilities also same like assets. We have current, we have non-current. Current means they are short term. Okay, like they'll be settled. This time it is settled. Okay, because you're going to pay. Normal trading cycle, it is also held for trading and also it needs to be settled within 12 months. Same properties like assets. If it is not held for 12 months, more than 12 months, if it is not held for trading, not in the normal trading cycle, it is a non-current liabilities. Like your bonds, your long-term loans, your debentures. Now, we are moving on to the statement of profit and loss and other comprehensive income. So IAS 1 says, it provides the definition of these things. What is it? Definitions of other comprehensive income. Any income or any expense that is not in profit and loss goes to other comprehensive income. Okay, what goes on other comprehensive income? For that, you need to go through the particular IFRS standard. Okay, particular IFRS standard will say, okay, this component will go to OCI, short form of other comprehensive income. I'm going to refer OCI. So the moment I say OCI, you should know it's other comprehensive income. Okay, so particular standard says that this component goes to OCI, this component go to profit and loss. Okay, so to know the detail of this, you will only understand this when you go through all the IFRS standards. You will have a clear picture of this. But know that very few income and expenses goes to OCI. So this should be easier for you to remember. Then we have total comprehensive income. What is total comprehensive income? TCI. Total comprehensive income is your profit and loss plus your OCI. Okay, this will be shown in your the statement. Now, OCI is classified in two groups. That OCI, that itself is classified into two groups. One is that it cannot be recycled to profit and loss. Sorry, one is it could be recycled to profit and loss. That means later, in your later accounting periods, whatever the amount you have recognized in OCI, you can put it in profit and loss. Example, under IAS 21, we still didn't cover IAS 21. Okay, we just started with the standards IAS 1. Okay, before this we have just finished conceptual framework. That was my first lecture. Second lecture was ethics. Third lecture onwards, all will be standards only. IAS 1, IAS 2, IAS 8, IAS 10, like that. So IAS 21 is long way to go. But anyway, when we go through IAS 21 also, this will be repeated. That whatever the foreign exchange gain and losses are there due to translation goes to OCI. Okay, but this can go to profit and loss in the later year. How? When you sell the subsidiary off, that foreign subsidiary, you are selling it off entirely. Whatever the profit in OCI goes to profit and loss, according to IAS 21. Second example is under IFRS 9, that is your financial instruments. You must have heard the cash flow hedging. There are two types. One is fair value hedge, the other one is cash flow hedge. Okay, what is cash flow hedge and all? You will definitely know it when we study IFRS 9, in case you forgot from your financial management or financial reporting. Then third, we have IFRS 9. Any debt instruments that has been remeasured, okay, that means it is classified as fair value through OCI under IFRS 9, again it can go to profit and loss. Okay, but this few examples you should know. Things which can be recycled, reclassified or recycled, anything. Things which cannot be recycled. The list you should know. It's very important. Because there are only few items that will be tested from this area. Second category is that which cannot be recycled. That means forever it will be under OCI only. Example like IAS 16 and IAS 38. IAS 16 is your property, plant and equipment. IAS 38 is your investment property. Yes, if you have any changes in revaluation surplus, it goes in OCI only. Second is under IAS 19, that is your employee benefits. Right? Anything regarding your defined pension benefit plans, remeasurement component will go to OCI only. It will never go to profit and loss. Third, again under IFRS 9, but this time it is equity instruments. Remember, debt instruments, you can reclassify the profit and loss. Equity instruments forever stays under OCI. Then we have income tax. Okay, income tax that is relating to OCI. This you can present in two ways. One, either you can disclose each component of OCI net of related tax effect. That means you deduct the tax from each of the element under OCI and then show. Second way, show all OCI, okay, without tax, okay, and then only one amount for tax at the end. That way also you can show. If you're not understanding the difference, we'll show you the format. The format is there. Okay, this is just an explanation before I show you the full-fledged format. Then, as I told before, entities can either show combined OCI and profit and loss, or they can show profit and loss separate, OCI separate. Okay, entities have that option. Now we are going to go through the format of statement of profit and loss and OCI. So this is how it looks like. You start with the name of the company. You write the name, that it is a statement of profit and loss and other comprehensive income for the year ended. Now in your SBR exam, you will not be asked to prepare this full-fledged statement of profit or loss or even statement of financial position, but extracts of it might be asked. So for that, you should know it. Okay, so you start with revenue, cost of sales, gross profit you get, deduct, add all income, deduct all expenses. What type of expenses? Distribution expenses, admin expenses, operating expenses, finance cost is an interest on loan. Then share of profit of associate. In a group accounting, you'll be having this. What is associate? In case you forgot, we have subsidiaries, we have associates, right? When you have an interest in an entity, from 20 to 50%. Between 20 to 50%, it is known as an associate. It is not a subsidiary. Subsidiary means you're having more than 50%. Less than 50%, but more than 20 is an associate. Okay, for that, the share of their profit will be taken here. That will be added in your income statement. Then we have profit before tax, deduct income, and profit for the period. Okay, so that the next two slides are the continuation of this, because I don't have space to put everything in one. So after profit for the period comes the next line, that is other comprehensive income. So your profit will always be first, OCI will be down after the profit figure. Okay, then other comprehensive income. When you're putting other comprehensive income, just see, one is items that will not be reclassified. Down we have items that will be reclassified. So there are two categories. So you have to put it into separate categories like this. So in the item that is there which will not be reclassified are changes in revaluation surplus, then defined pension plans, then equity instruments, then income tax that will not be reclassified. You can learn from this list. This list will help you. Items that will be reclassified, items that will not be reclassified. Then we have items that will be reclassified. Only two things are there: cash flow hedge and exchange differences. Again, income tax here also we have that will not be reclassified and reclassified. After that, total comprehensive income. Total comprehensive income means you add other comprehensive income. When you add other comprehensive income, it should be both items that will be reclassified and items that will not be reclassified. Both together you have to add with your profit for the period. That's here. Profit for the period, you have to add it with both your OC and you get your total comprehensive income. Sorry, total other comprehensive income. Add both your comprehensive. Total comprehensive income is we are adding both comprehensive income plus profit and loss. We are definitely going to do a question on this. Okay, not in this lecture, but maybe in the future. This is just, we are just learning the presentation, because IAS 1 is what? Presentation of financial statements, how it is presented. That's all you have to know. Because if you don't know the presentation, no use of studying other standard, how profit and plan will be measured or reported, how tax will be no. First you need to understand what things comes under what, how it is presented. Then only you can study the standard dealing with particular area. That's the very first reason why I've started with IAS 1. Then after this is the continuation. After total comprehensive income, below comes profit. One is profit, the other one is total comprehensive income. Profit which goes to parent, which goes to NCI. Total comprehensive income also which goes to parent, which goes to NCI, your non-controlling interest. For example, you have purchased 80% shares in a company. So 80% is for the parent, 20% is for the NCI. Okay, for profit also you have to divide like that. Total comprehensive income. Total comprehensive income means other comprehensive income plus profit. Because sometimes students take other comprehensive income. No, it is total comprehensive income. That goes to parent and NCI. NCM is non-controlling interest. And remember, the profit that you have given for both the parent and NCI should be equal to your profit for the period. That was there in the first slide. And your total comprehensive income that goes to parent and NCI total have to be equal to your total comprehensive income. Okay. Now, the third component, statement of changes in equity, does not usually come in SBR exam, but at least you should know how it looks like, what element to include if it comes. So this is regarding any changes in the equity. So this will include issue of shares. When you have issued a share, this will be dealt in which statement? Statement of changes in equity. It will not go in the income statement. It will not go in the statement of financial position. It will go under statement of changes in equity. Dividends. Dividend is related to shares. So again, statement of changes in equity. Now, you need to know that when you're making statement of changes in equity, a comparative statement has to be there for the prior period. Why? You need to compare how much your shares have increased, how much your dividend has increased or decreased. Comparative statement. Previous year's statement of changes in equity you need. This is how it looks like. I hope you can read it because it's very small. Okay, so you have different columns starting with your equity capital, retained earnings, translation of foreign operation, financial assets through OCI, cash flow, hedge, revaluation surplus. All this will come statement of changes in equity. Next, and when you go in the row wise, it starts with opening balance. Then if there are any changes in accounting policy, that also you have to take into account. Then we have restated balance. After that, changes of equity for 2003. Whatever the changes during the period, starting with dividends. Dividend, if you see, it is deducted from retained earnings. Even in the total also it will be there. Then we have issue of equity capital. Issue of equity capital, add in the equity capital and add in the total. Total comprehensive income. This goes in all the areas, all the excess if you see. Retained earnings, translation of foreign operating, financial assets, cash flow and revaluation surplus. Then we have transfer to retained earnings. Anything that is transferred to retained earnings will be added to retained earnings and deducted. For example, cash flow hedge. Sorry, revaluation surplus. Maybe from revaluation to retained earnings. So deduct from revaluation surplus, add to retained earnings. In the total, nothing. Because adding and deducting in one area, effect is null, zero. That's when the total is nothing. So anything regarding dividend, anything regarding share issue will come to statement of changes in equity. But this is a rare statement that comes. Okay. After that, this is the continuation, the next slide. After the transfer to retained earnings comes the closing balance. Okay. Now, in addition to this column, there should be two more columns. One is for NCI, one is total equity. What goes to the NCI? That also has to be there, but it is not included in this. Now, from component of financial statements, that's over. The other areas we didn't cover, notes, then the statement of cash flow, those areas we didn't cover. For that, we have separate statement. Okay, and those are pretty easy. But mostly the statements that we are focused on, statement of financial position and income statement, statement of profit and loss and other comprehensive income. These are the two statements. Next is the general features of financial statement. There are some general features. That means every financial statement has to be prepared or needs to include this certain qualities. First one is going concern. Any financial statements, you always prepare assuming that tomorrow also you will continue. At least within 12 months you will continue. At least for the next 12 months you are going to continue the business. So IAS 1 says that management should assess whether going concern assumption is correct or not. You have to check for the facts, whether you going to be able to operate for the next 12 months or not. If it is so, you are going to prepare your financial statements in a going concern basis. Okay, but what if there is some uncertainty after getting all the information that you will not be able to survive in 12 months? What happens? You cannot prepare the financial statements in a going concern basis. Then you need to change. Once management have assessed, okay, that there are no material uncertainties, that means you are sure you are going to continue, then go by the fact that it is a going concern and you have to prepare your financial statements in a going concern basis. But how do you know that there are going concern issues? You are uncertain whether you are going to continue or not. These are some indicators that you need to look for. Okay. A lack of cash or cash equivalent, whether they have lack of cash or cash equivalent, whether overdraft increased or they are taking some short forms of borrowings like short-term loan or anything. Debt repayment is major and is going to and it is due in the next 12 months. A rise in payable days. This you can get through the calculation of payable days. Increased level of your gearing increase so much. Gearing increase so much means you are relying on the borrowing more to finance your working capital or your long-term expansion. Cash flow is negative. This you will get from your statement of cash flow. Regarding especially in the area of operating activity, we know that cash flows are divided into three group. What are they? Operating activity, investing activity, financing activity. In the operating section, because that is where you rely on in cash flow from your trading activities or operating activity. So if that is having a negative cash flow, you're going to face a problem. Or disclosure relating to the material legal claims. For example, you are having a court case against you. A customer has filed a case against you and you are most likely to lose that case. That means you have to pay a huge amount, right? And also is going to harm your reputation as well. So these are some indicators of going concern. That means you will be having problem to continue the next 12 months if these things are there. So when you're reading the case study, as I told you, ACCA exams are based on case study. Small case study they will give you based on that. So in that case study you have to look for these facts, whether they have lack of cash, whether gearing increased, whether debt repayment is due in next 12 months. You have to see for those things. If it is there, yes, you can say that this company cannot prepare financial statement based according to IAS 1. You also need to know how to write your answer in SBR, but it's a bit too early because we still didn't do a question on this. But definitely when we do a question on a standard, I will teach you and I will show you how to write a question. But for right now, let's go through the concept. Oh yes, and the last one is large impairment losses. If you're having a large impairment, that means the value of an asset is going down. That is the meaning of impairment. For that also we have a separate standard, so don't worry. Second feature of financial statements are accrual basis of accounting. If you see that when you're recognizing some transactions, whether in your financial statement of financial position or statement of income statement, you recorded, okay, based on when it has occurred, not based on when are you going to receive your cash or when are you going to pay. It's not a cash basis, accrual basis. For example, whenever revenue has occurred, you will recognize it. Whether you have received the cash or not is a separate thing. Then the third feature is consistency of presentation. For example, you have decided that a particular asset is a current asset. You have classified it as a current asset. So for the next year also, you're going to write it as a current asset. You're not going to change from current to non-current all the time. Very frequently, no. Okay. But you can change. Exceptions are there. Only when you feel the change is very much appropriate. It gives a better presentation. Or a particular standard requires the change. Fourth feature is materiality and aggregation. That means when you are disclosing something or the way you are putting, you are putting it based on materiality and aggregation. You are aggregating. What is materiality, by the way? Materiality means if you omit or you misstate any information that you feel can influence your user up to a great extent is known as materiality. But to decide materiality, remember the management, it should be based on quantitative as well as qualitative factor. You have to see the quantity, not only the number, the amount, also the qualitative factor matters a lot. For example, some industry, some factor will be material. For the other industry, that factor might not be material. Okay. So you have to see when you're assessing materiality, you have to look for the characteristics. You have to see who are the users of the financial statements. To help the user, financial statements should show material classes of items separately. When something is very material, you do not put them together under one column. No, separately you show each item because they are very material. If it's immaterial, aggregate everything and show as one figure. That's the rule. Okay. Offsetting is the fifth feature. Okay. Offsetting means IAS 1 says asset and liability needs to be shown separately. Even though we are deducting assets and liabilities in the statement of financial position, but we do not deduct and show the amount. Reduced amount we don't show. Assets separately, liability separately. Same way for income and expenses. When we have to get the profit, what do? We deduct expenses from income. So some might think, why not just deduct expenses from the income and show the amount? No. Income separate, expense separately. You cannot offset like that. IAS 1 says so. You can only offset when a particular IFRS standard says you that it is required by the standard or the standard permits you to offset. Otherwise, you cannot offset. Then the sixth feature is comparative information. Comparative information should be there. For example, the previous year statement of financial position, previous year income statement should be there for you to compare how much your asset has increased, how much your liability has went down or increased, things like that. So these are some features of financial statements, 6 features, and you should know these features of financial statements. See, they will not ask what are the list the 6 features of financial statements, and you're writing no. This is not knowledge based paper. This is a practical paper. You just need to know. Suddenly some asset and liabilities come. You should be able to tell that you cannot offset. Why? Because you know it's a feature of financial statements. Then the third is disclosure. Now we are moving on to disclosure. When you have to disclose also, there also we have certain rules. You just cannot disclose the way you want or in any order. IAS 1 says disclose in a systematic order. What does it mean, systematic order? Give prominence to the most relevant areas. Some areas are more relevant than others. You have to give them more importance. They need to be disclosed first. Items, okay, you can group items which operate in a similar way. For example, you see assets held at fair value. There are 5 assets that are held at fair value. Group, add all the 5 assets held at fair value and then show, rather than showing separately the 5 assets, because all are held at fair value only. So it does not make a difference. Third, follow the order in which items are presented in statement of profit and loss and statement of financial position. For example, you start at statement of financial position, we usually start with both land and buildings. We start with non-current asset. So when you disclose also, you disclose non-current asset first, then current asset, then liabilities, like that. Same way for statement of profit and loss, we start with sales, then we start with cost of sales. So like that you have to disclose, that order only. Then compliance with IFRS standard. This is regarding the how you present the disclosure note. Next is how you comply. So when you comply with a particular standard, for example, you are complying with IFRS 9, let's say, or any IFRS standard, you have to make a note. You have to disclose that also, that you are complying, that this financial statement is complying with IFRS standard. Because then auditors are going to use this statement. Okay. Accounting policies needs to be disclosed. For example, a company, okay, which measurement basis have you used for your non-current asset? Did you use historical cost or did you use fair value? That you need to disclose, because you have a choice. Wherever choices are there, you need to disclose it, which basis you have used. Second, each significant accounting policy, if you have used any significant accounting policy, needs to be disclosed. Then we have sources of uncertainty. If there are any sources of uncertainty, again it needs to be disclosed. For example, you have some information, okay, regarding assets and liabilities that can affect your assets and liabilities within the next year. Within 12 months, it's going to affect your assets and liabilities. You need to disclose it. Not any uncertainty. If it can materially change your assets and liabilities, then only. Then we have reclassification adjustments. See, any area which is important under disclosure, that means the bold, I have already bolded it. They are the subheadings. This needs to be disclosed, okay? Reclassification adjustments. That means any items that are recycled from OCI to profit and loss needs to be disclosed. See, items that are not recycled, nothing to worry about it. It will be there in OCI only. But if any item goes to profit and loss from OCI, needs to be disclosed. Okay. IAS 1 says when you are reclassifying, either you can show it on the statement of profit and loss or you can write it under notes. Okay, choice is there. The last part is the criticisms of the use of OCI. So from disclosure we are heading towards criticism. That's the last part of this lecture under IAS 1. We have almost finished all the parts of IAS 1, that is how to present your assets, your liability, your income statement. Okay, this has been criticized. Why? What are some criticism? First, users ignore OCI. If you see, when you go through your profit and loss, do you go through OCI in detail the way you go through profit and loss? No, most of the users, they ignore OCI because they believe any gain or losses that are not related to the interest trading cash flow, why to worry about it? They care about trading cash flow, that means profit and loss. So if sometimes what happens, some material expenses or income might be hidden under your OCI, which users do not give attention. So that's criticism of OCI. That's not a good thing. Second, reclassification from OCI to profit and loss. It is also criticized because see the time you reclassify, that is a different time period is different. When the change in related asset or liability happened, that time period was different. But this contradicts with the definition of income and expenses in the conceptual framework. Now you understand why that first lecture was conceptual framework, because everything you need to refer back to conceptual framework, whether it goes with it or against it. What does conceptual framework says about definition of income and expenses? It says any changes in asset or liability will give you income and expense, correct? But it has to be recorded in the same period. For example, depreciation from your asset. Asset you are recognizing a statement of financial position. Depreciation you are recording in income statement. The expenses. It's a depreciation is an expense, but in the same period, not in different periods. But here, when you are reclassifying to profit and loss, you are recording it in a different period. Income expense in different period, asset liabilities in different period. You understanding? So these are the two criticisms of OCI. Now, let's summarize what we have discussed. We started with the components of financial statements. What are the components of financial statement? Statement of financial position, statement of profit and loss, statement of changes in equity, statement of cash flow, accounting policy notes, and other explanatory notes. We went through first three in fact. Statement of financial position, we discussed how liabilities and assets are disclosed as current and non-current. Statement of profit and loss, OCI. Statement of changes in equity, I just showed you the format. Any changes in equity or dividend. Statement of cash flow and policy note we didn't cover. Okay. Then we went through general features of financial statements. There are 6 features starting with going concern. Second is accrual basis. Anything occurred, you recognize it, not based on cash. Consistency. Anything you classified as current or non-current or any particular way needs to be classified in the same manner every year. Unless IFRS demands or you feel it is more appropriate to present in a different way. Materiality and aggregation. Anything that is material, show separately. Anything immaterial, aggregate and show. Offsetting. Your income, expenses or asset liability needs to be shown separately. You cannot deduct and show unless IFRS standard says. Comparative information needs to be shown where you can compare with the previous year. Okay. So these are the 6 features. Then we went through the disclosure. Under that, we went through the disclosure note. That means you first need to give prominence to the most relevant areas. Second, you need to follow the way your statement of financial position or statement of income and loss, the items are presented in that order you have to disclose. For example, you're starting with sales. You need to disclose also starting with sales. Okay. compliance with IFRS. Okay, you need to disclose. You need to write a statement that you are complying with IFRS standard. Third, any changes in accounting policies you need to disclose. If there are any sources of uncertainty, needs to be disclosed. Reclassification adjustment again needs to be disclosed. And last but not the least is the criticisms of the use of OCI. What are the criticism? When you reclassify different time period. Second criticism is it is often ignored by the user. Okay. So that's it for this lecture. Thank you for watching and we'll be seeing you in lecture 4 with the next standard.